I have some breaking news to share because average daily rates have been decreasing big time over the past 3 days. So from Wednesday through Friday last week, rates decreased by 50 basis points or 0.5 percentage points. Now, that may not sound like a lot, but there's only 3 times over the past decade in which rates have decreased that much, which is absolutely insane. So I'm going to share how this is currently impacting home buyers right now, and also share how, or I should say, I'm going to share why rates decreased so much over the past 3 days, and also how this changes the likelihood of another rate hike by the Fed. So I have a lot to share in today's video. Let's go ahead and begin. So as of Friday, rates decreased to 7.38% for an average 30-year fix. Again, for people with exceptional credit buying a primary residence and putting down at least 20% to buy a house. So it's the best case scenario regarding average rates on a national level, falling 13 basis points today, but that was after we had a decrease of 18 basis points and 19 basis points over the previous 2 days. So a jumbo rate is at 7.75% and VA is around 6.70%. Looking at here, 7.38%, I should say, the lowest rates we've had going back to September 20th this year. Also, have a look at this because the daily rate as of 12 months ago was at 7.30%. So rates are more or less flat compared to 1 year ago, which is night and day difference compared to just 1 week ago. 1 week ago, the difference between this year and last year was a difference of 84 basis points. Now, this is quite the turnaround as well, because when we zoom in here, let me just do that right there. Look at this. Back in October 19th, we had rates at 8.03%, the highest rates since the year of 2000. So rates have decreased big time over the past several weeks now. Now, here's an article I found from the Mortgage News Daily, just posted on Friday here. It says the average top tier, in other words, the best rates you can get overall for a 30-year fixed rate, was over 8% as of recently, as of October 19th. At the start of the present week, things weren't looking much better at 7.92%. So 1 week ago, we're at 7.92%. Now we're at 7.3, just over 7.3%. It says, what a difference a few days make, especially last 3. The improvement seen on Wednesday through Friday is the third biggest in well over a decade. And if you throw out March of 2020, which is obviously more impacted by COVID lockdowns, the onset of COVID here, we're only left with one example, which was November of 2022, in which rates decreased more in the 3-day period here. So big picture here, this huge decrease in rates is quite unusual, to say the least. Now, I want to share why rates have been decreasing so much late last week, but also, again, I want to share the current impacts for home buyers right now. If you're looking to buy a house right now, here's what you're looking at. So if you're looking to buy a $400,000 home, putting 20% down, your rate 2 weeks ago was at 8.03%. So looking at your P&I payment, or your principal and interest payment, excluding taxes, insurance, and HOA, because that varies widely depending on the area you're looking to buy, your housing payment, P&I, would be $2,355 per month. Now, when looking at daily rates as of Friday at 7.36%, using this same example here, your housing payment would be $2,207 per month. This means over the past 2 weeks alone, you're going to save approximately $148 per month in your housing payment, because rates have decreased by nearly 70 basis points or 0.7 percentage points. On top of that, because rates have decreased by about 70 basis points, this means that your purchasing power just increased by 7%. So not only are we saving about $150 per month, but also your purchasing power just increased by 7% as well. On top of that, the total number of interest paid over the life of that 30-year fixed rate loan actually just decreased as well. In fact, it decreased by $52,000. Looking at rates at 8.03%, you're going to pay about $528,000 in interest paid over the life of the loan, which, by the way, is higher than your original purchase price of $400,000. Looking at this scenario, when rates decrease to 7.36%, your interest paid is just under $475,000. Now let's talk about why rates have been decreasing so much over the past several days, especially on Friday. So on Friday, the yield on the 10-year US Treasury note, which is tied indirectly to the direction of mortgage rates, was just under 4.6%, a decrease of 9 basis points compared to Thursday. Earlier today, which is on Friday, the yield here decreased by about 11 basis points. So it improved slightly, but still decreased big time, which is one reason why rates decrease so much today, which is Friday. So why did rates decrease so much today on Friday? It says, according to CNBC, Treasury yields tumble after October payrolls report misses expectations. And it missed expectations for a number of different factors here. So according to CNBC here, non-farm payrolls increased by $150,000 for the month of October, but the forecast called for $170,000. So that was a miss. On top of that, that was a sharp decrease from the gain of $297,000 that we saw in September. In addition to this, unemployment rate also increased as well, going from 3.8 to 3.9%. The forecast was also at 3.8%, so it came in below, or actually came in higher than the street's forecast here. Also, this rate at 3.9% is the highest level since January of 2022. Now here's a look at job creation ever since January of 2022. So this October, only 150,000. In September, 297,000, which, by the way, 150,000, excluding June this year, when we only saw a gain of 105,000. That's the lowest number of job gains since at least January 2022. So it appears our labor market is slowing due to the fact that unemployment rate increase, household earnings also decrease, and also we're seeing job creations slowing down as well. So labor market is slowing down, which is exactly what the Fed wants to see, because when unemployment increases, when people lose their jobs, when we have less jobs being created, that should imply that inflation will decrease as well, which again is exactly what the Fed wants to see, right? So CNBC also noted here that average hourly earnings, a key measure of inflation, increased only by 0.2%, but the forecast was a gain of 0.3%. So we're seeing fewer jobs being opened, but also we're seeing earnings not increase as much as what was expected here. It says here the Fed uses wage data as a component of its inflation watch. The central bank has opted not to raise interest rates in their past 2 meetings, despite inflation running well below or well above the 2% target. Following Friday's jobs data, markets further reduced the probability of another rate hike in their next meeting, which is in December this year. Now, speaking of that, let's have a look at that. So this is a CME Fed Watch tool. If you just Google that, it takes you to this website here. This provides the likelihood that the Fed will change the federal funds rate in their upcoming meetings here. And by the way, the next meeting is on December 13th, 39 days from Friday here. So this is a new change here because there's only a 4.6% probability that the Fed will increase rates to 5.75%. In contrast, there's a 95.4% chance that the Fed will pause in their last meeting this year. Now, this is quite the difference between what was the forecast last week and also the forecast from 1 month ago. So again, a probability of only 4.6% to raise the federal funds rate from 5.5 to 5.75%. Just 1 day ago, the probability was at 19.8%. And 1 month ago, the probability was 39.4% versus only a 4.6% chance right now. So it appears, based on the latest data we have right now, that the Fed is going to be done with any Fed rate hikes this year and also potentially next year as well. So looking at this tool here, the next move by the Fed would be a rate cut. This actually just got revised as well here because by a 49% probability, they're calling for a rate cut of 25 basis points going from 5.5 to 5.25%. That's their meeting for May 1st next year. Now, this is quite different compared to just 1 day ago and from a month ago as well, because at 49% right now, yesterday, I should say on Thursday, the probability was at 37%. And 1 month ago, it was at 20%. So based on this jobs report from Friday, it appears that the next move by the Fed will be a pivot. And actually that pivot will come sooner than was previously expected. Obviously, a lot of incoming data will become available from now until next May, of course, but that's what we're seeing right now. Now, let's also talk about why rates decreased so much on Wednesday and Thursday as well. This is investing.com. If you actually just Google investing.com economic calendar, it takes you this right here. When you go there, by the way, you have to click on filters, then click on clear, and then click on the United States here. So let's have a look at what happened on Friday first. Average hourly earnings month over month increased only by 0.2%. The forecast was a gain of 0.3%. Also below levels compared to 1 month ago, a gain of 0.3%. I should mention this is the actual number, this column right here. Here is a forecast and here's the previous reading here. So this is October, a gain of 0.2%. September, it was at 0.3%. So we're seeing softness or in the labor market regarding earnings here. Also regarding job openings as well. So non-farm payrolls came in at 150,000. The forecast was 180,000, also well below September at 297,000. Unemployment came in hotter than expected, 3.9% versus 3.8% forecasted, and also 3.8% in September. So that was what happened on Friday. Here's what happened on Thursday, which is another reason why rates decreased so much here. So continuing jobless claims was at 1,818,000. The forecast was at 1.8 million. So it came in higher than expected, also higher compared to the previous month. Initial jobless claims, 217,000 versus 210,000 expected. Also, unit labor costs decreased by 0.8%. The forecast was a gain of 0.7%. Now, this number here is the annualized change in the price that businesses pay for labor, excluding the farming industry. It's a leading indicator of consumer inflation. So labor costs actually decreased when the street was forecasting a gain of 0.7%. Now that was Thursday. Let's have a look at Wednesday because ADP non-farm employment for October saw a gain of 113,000, well below the expectations of 150,000. Also, the JOLTS report, which is job openings, came in at 9.553 million, higher than the forecast, but more or less flat compared to the previous month. So based on all this economic data, which is implying that our economy and our labor market is slowing down, is one of the main reasons why rates have been decreasing so much over the past several days. In fact, over the past 3 days, this is Wednesday, Thursday, and Friday, a giant decrease of 50 basis points, the third biggest decline in over 1 decade. Absolutely insane. So please leave a comment below with your biggest takeaways from today's video. Also, if you guys got any value in this video whatsoever, then please hit the like button. I greatly appreciate that. Of course, I appreciate you. Like and subscribe. Hope you have an awesome day. I look forward to seeing you on the next video.